Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder here. Welcome back to ETF Spotlight. Now we know a lot of you love dividends. You love the yield, you love it coming in so frequently, and knowing that the growth is there and that it's always on time and having a little steady peace of mind. Well, today we are joined by DJ Tierney from Charles Schwab to talk about SCHD, the fund that most of you all know so well. DJ, how are you doing?
I'm doing great, Daniel. Great to see you. Thanks for having me today.
Yeah, so let's talk about the legendary fund. Everybody obviously has questions when it comes to how do you continue to do what you do in a market that's constantly changing, especially in the focus of dividends.
Yeah, I mean, the Schwab U.S. dividend equity ETFs had a great history in market for a little over 13 years. And, if you look at the dividend space, there's a lot of competition out there. There's a lot of other funds. And dividend investing in general, what are we looking for? We're looking for companies that pay high dividends. If you look at some of the other funds that are out there, what they do is they really gravitate towards just that, the dividend yield. Others, will look at the historical, like their ability, their history of paying dividends. And what you see with SCHD is we do a little bit of all of that. We look at its dividend yield. We look at its history. It has to have paid a dividend. Its constituents have to have paid a dividend for 10 straight years. And then most importantly, we go deeper and we actually look at the fundamental attributes of the companies themselves. What we're looking for are companies that can sustain and potentially grow that dividend. So the methodology of the index that it tracks does that. So it really goes a step beyond what a lot of the other competing funds do. And I think that's borne out in its history of delivering growing dividends and competitive market returns.
And the long market returns have been absolutely amazing. Let me first say that. But in an essence of a market like the one we're experiencing so far this year, how does it manage the volatility so well?
Well, I mean, just to be clear, it's a long equity ETF. So it consists of stocks from 100 different companies. And so there's nothing in the structure to buffer you directly from the equity markets. But when you select companies that have strong cash flow versus their debt, lower or higher ROEs and historical precedents of paying dividends, that ends up distilling both high quality and high value factors. And amidst market volatility, value and high quality stocks can perform with less volatility. And I think that's what you've seen. That's what we're referring to with SCHD.
Yeah. So 5-year earnings growth rate of 9.68%, return of equity of 28.24%. How does SCHD maintain these metrics relative to the peers that are competing against you in the same space?
Yeah. So again, back to that methodology, and I can. One of the things that's great about the U.S. dividend equity ETF methodology is that it's pretty explainable. And so I'll give you the quick hit. First, we look at the broad U.S. equity market and we say which companies have paid a dividend for 10 straight years. If you pass that hurdle, you're still in the mix. And then we look at the actual dividend yield. And it's a dividend ETF. So we eliminate the bottom half of dividend paying companies just on yield alone. And then of the remaining companies, we look at 4 different factors. What is your return on equity? What is your cash flow versus your debt? What is your dividend yield against? That dividend yield comes back into play. And then what is your 5-year dividend track record, growth record? And so by weighing those 4 equal weights and then using them to select the top scoring companies, that's where you tend to see that high ROE. That's where you tend to see that earnings growth trajectory just because it's in the methodology. So, we do that in a disciplined, systematic way with an annual reconstitution, rebalancing throughout the year to keep the diversification where we want it for the methodology. But that's how it's done. Elegant, easy to explain. And as you point out, it's had some pretty nice results.
Yeah, no kidding. So the systematic approach that you're referring to, is there a certain yield level that it just perceives as, this yield is way too high. Obviously, the company is way too risky. Let's not even touch it.
No, there's nothing to take out. On the bottom half, if your yield isn't high enough, it will take it out. But no, there's nothing to cap the yield at the top. I would mention a couple other things in the methodology. Real estate investment trusts and MLPs are taken out as a part of the process. There are some other funds that don't do that, where you tend to see maybe some high yields from some real estate investment trusts. But we kind of view that as a different asset class, so we take those out. But really, when it comes down to the other factors that are part of selecting the companies, ROE, cash flow, those weigh just as heavy as the dividend yield does. And so while SCHD tends to feature a very competitive dividend yield amidst the category, it's not always the highest, because again, some of the strategies out there just look at dividend yield and select the highest dividend yielding companies. So we feel like ours is the right blend of dividend results, but with pulling out companies that are likely to continue to pay them and grow them over the long haul.
DJ, we're talking about tens of billions of dollars of assets under management in this fund with an expense ratio of only 6 basis points. How do you do it? How is that possible?
Well, if you look at Schwab Asset Management and our approach to the ETF market, you'll see that. We use our scale as a top 5 ETF provider to constantly look for efficiencies and lower costs. And costs matter. The less fees you pay, the more money stays in your portfolio and grows over time. So we want to strive to be cost competitive and be among the lowest cost lowest cost ETFs in any place we compete.
Amazing. So I want to go back to, systematic approach that you have going on, obviously cutting out bottom parts of the dividend yield. Let's talk about sectors, though. Is there any time that the fund might get too overweight one sector? Is there a trimming side of the system there?
Yeah, thanks, Daniel. That is, again, a part of the methodology. After the 100 companies are selected, they are then weighted by market capitalization. So it has a tilt towards the bigger companies, but then they're capped at 4%. So no individual index constituent will be larger than 4%. And then at the sector level, to your point, you could have sectors that would really rise in prominence. So we cap any individual sector at 25% of the fund. And that's just a way to foster diversification across sectors and across companies, which again can decrease the volatility at the fund level.
Yeah, I know the investors listening right now, they're maybe are more risk averse. Love hearing that as well. So let's talk about Charles Schwab and the fund and the company. I mean, obviously, this landscape of the ETF asset class is continuing to evolve. We're seeing new crypto funds. We're seeing trillion-dollar inflows. We're seeing money come into the space like never before. How is Charles Schwab and maybe this fund, how are you planning for the future to stay ahead?
Well, we've got a nice 15-year legacy as an ETF provider, and I think what we've demonstrated over the last 15 years is consistency. And so, really, we want to be there with core building block asset classes at low cost with predictable index adhering results. And so, really, that's what we're doing, and I think that's what you can expect to see from us in the future. We have continued to bring new ETFs to market steadily over the last few years. We've been building up over in the fixed income asset class with new products. In this dividend space, I will say, in response to investors' interest and requests, we brought an international kind of sister ETF to SCHD, SCHY, which features a lot of the similar methodology, but for international stocks. So I think we'll continue to listen to our investors, kind of try to see the world through investors' eyes. And if we think there's some spots that we don't have, and we have 32 ETFs now, but if we think there are opportunities where we can deliver value with low cost, predictable ETFs, we'll certainly consider them in the future.
We'll definitely have to have you back on for an episode about the international angle as well. Thank you for bringing that up. So let's talk about current market, SCHD, dividends. People are focused on that, but now we're in this environment as well, where the treasury market is actually paying a pretty substantial yield. So how do you think investors are going to be looking at SCHD in this new environment?
Yeah, I mean, so they're different asset classes. Every investor's got a different circumstance, right? So it's hard to generalize. But I will mention we have model portfolios that we construct at Schwab Asset Management. And if you look at how we construct our income-oriented model portfolios, we'll blend dividend-paying stock strategies like SCHD with fixed income. And if you blend them together with targeted allocations and rebalance over time, that can really work well. So, we think that they both serve places in a diversified portfolio. The differences would be with SCHD, with an equity ETF dividend strategy, you've got potential, appreciation over time. If the market appreciates, you'd expect to participate with that, where that won't happen with fixed income, really, where you've got a fixed principal. And so, potential for growing dividends, potential for capital appreciation, but that comes with risk, right? Markets don't always go up, and in volatility, you can certainly have depreciating markets. Where in fixed income, it's just, it's a steadier asset class, much lower volatility, much more predictability. And to your point, thankfully for the first time, we've gotten away from the zero interest rate environment where you actually are getting compelling yields of 4 or 5% in investment grade bonds and treasury bonds. So, it's a welcome thing for savers and anybody certainly approaching retirement to keep their fixed income allocations where they should be.
All right, DJ. So I'd like to throw one more kind of curveball question at you here. So we have the new administration that's obviously coming in. They're swinging their bat, and it looks like the tax code might be changed down the line if they have their way. So that could implicate, changes to dividends or long-term, short-term capital gains tax. How is Charles Schwab setting up the ETF funds and thinking about that potential in the future space here?
Yeah, thanks, Daniel. Certainly a lot for investors to consider these days. But what I would point out is that we don't really have a great, no one has a great crystal ball to know exactly how future tax policy might evolve. So rather than worry too much about what we don't exactly know, we focus on what we can control. And so we're very dedicated to bringing tax efficient and low cost products to market. And so if you look at SCHD, if you look at any Schwab equity ETF, we've never distributed a capital gain in any of our equity ETFs to date. And so, that's something that we can control, the tax efficiency of our products. What can we control? The cost efficiency of our products. So we'll continue to keep our focus there on what we can control rather than, try to react with what we don't know about the future.
All right. Well, DJ, let's go ahead and leave it there. Thank you so much, DJ Tierney from Charles Schwab, everybody. And also, I know there's 108,000 of you already following this ticker symbol on Seeking Alpha. So we hope you enjoyed the episode, and we'll see you here in the next ETF Spotlight. Take care.